Welcome to the deep dive. Today, we're going beyond the familiar labels, past the Truly, the Modelo, the Sam Adams.
Yeah, we're digging into the actual corporate machinery behind them, the big beverage alcohol players.
Exactly. The mission here is to really understand their biggest bets, where they might be vulnerable, and frankly, who's actually calling the shots.
And what we found, looking through these filings, it really boils down to a few key themes. You've got market volatility, these massive capital investment decisions, and crucially, how these companies are actually controlled. Governance.
Right. It's not just about selling drinks. It's high-stakes strategy, managing huge risks.
Absolutely. It's like a masterclass in corporate defense sometimes. And, protecting established power structures.
We've pulled out some really telling examples. We'll see how one company dealt with the financial hangover from the hard seltzer craze cooling off, and how another is pouring billions into Mexico to lock down its supply chain.
A huge bet.
And then there's the whole control thing, how these dual-class stock setups let founding families keep a tight grip no matter what the public market thinks.
Yeah. Fascinating stuff when you dig in.
Okay, so let's unpack this, starting with that volatile market piece. The hard seltzer category is the perfect example, right? And we can use the Boston Beer Company as our case study here.
Oh, definitely. It's just an incredible example of market whiplash. I mean, think about it. The category volume for seltzer exploded. What was it, like 158% growth in 2020?
Just massive numbers.
Totally unsustainable in hindsight. And then boom, demand just stalls. Growth slows way down to only 13% in 2021.
And Boston Beer, they'd geared up for the rocket ship, right? Ramping up production like crazy.
Exactly. They got caught flat-footed when the music stopped. Or, well, slowed down dramatically.
And you can see the pain right there in their financial filings. It shows the real cost when your forecast is that far off.
Oh, yeah. Because demand for certain styles just vanished. They ended up recording $19.6 million in cost in 2021 just for terminating contracts with their third-party producers.
$19 million just to stop making something. Wow.
And that's not all. The inventory problem was huge. All the stuff they'd already made or bought materials for,
right.
Their provision for excess or expired inventory, it jumped to $62.6 million in fiscal 21. That's way up from $11.3 million the year before.
So $62 million worth of product and material is basically just written off.
Pretty much. No net realizable value, as they say in the filings. That's what happens when tastes shift on a dime like that.
And that inventory mess, it really underscores the strategic risk they took, didn't it? Relying so heavily on outside partners to chase that boom.
It does. Their own breweries, the ones they own. The volume produced there dropped significantly. It was over 90% back in 2017, but by 2021, it was down to around 56%.
So they outsourced a huge chunk of production.
Which creates this lingering contractual risk. Even after the demand slowed, they're still locked into these agreements with third-party facilities, like City Brewing Company. They have minimum volume commitments they have to meet each year.
So even if they don't need the seltzer, they still have to pay.
Well, they face potential shortfall fees if they don't meet the minimums. The company actually projects they will fall short. And they estimate, get this, if future volume was literally zero under those contracts.
Oh.
The total potential shortfall fees could hit about $210 million. That's over the life of contracts running through 2031.
$210 million. That's quite the potential liability. Is that just bad forecasting, or is it, the inherent cost of trying to innovate so fast in a market that can turn on you?
It's probably a bit of both, right?
Yeah.
It shows that brutal trade-off, speed versus risk.
Yeah. But Boston Beer isn't just licking its wounds, obviously. They have other strong brands. Twisted Tea, for instance, that became the top flavored malt beverage in 2021.
Exactly. They're definitely still pushing innovation hard.
Yeah.
They launched Hard Mountain Dew, Sauce Agave cocktails, stuff like that in 2022.
And they're looking beyond alcohol too, right? Cannabis beverages.
Yeah, they set up a subsidiary in Canada to research and develop non-alcoholic cannabis drinks. Started sales up there in late 2022, I think. But the filings are clear.
Yeah.
No current plans to sell cannabis products anywhere else.
Okay. So that's the volatility picture. Now let's pivot. Let's talk about a totally different kind of risk profile. Not so much about market swings, but about massive long-term calculated bets. Constellation Brands, CBI.
Right. If Boston Beer's story recently is about reacting to volatility, Constellation's is all about building, well, almost an unshakable scale, securing dominance.
Specifically with their Mexican beer portfolio, right? Modelo, Corona outside the U.S.
Exactly. They're fundamentally betting on long-term volume growth for those brands.
Yeah.
And they're backing it up with serious cash. In fiscal 2024 alone, they spent over $900 million just expanding their brewing capacity in Mexico.
$900 million in 1 year. Wow. Just to make more beer.
Yeah, boosting capacity from 42 million up to 48 million hectoliters. And that's just the start.
There's more.
Oh, yeah. They expect to spend roughly another $3 billion between fiscal 2025 and fiscal 2028 on more expansion, optimizing things, new construction, all in Mexico.
$3 billion. That's a huge commitment. It's like they're trying to build a fortress around that production. Forget market fluctuations. We need capacity.
That's the strategy. But, committing that heavily to scale creates its own set of risks, operational risks, supply chain risks. Think about it. They rely heavily on just a few suppliers for critical things.
Like what?
Glass bottles, for example.
Yeah.
The filings mention one main producer supplies most of their glass containers for the U.S. market. If something happens to that supplier.
Yeah, all that brewing capacity doesn't help much if you can't put the beer in bottles. It's a big concentration risk.
It is. They do try to manage other risks, though. Input costs, for instance. They use hedging pretty extensively.
How much are we talking?
As of early 2024, they said about 79% of their forecasted transactional exposures for fiscal 25 were hedged. That covers things like aluminum for cans, corn, natural gas, diesel fuel.
Okay, so they're locking in prices for key ingredients and energy, trying to stabilize their margins even with that massive investment going on.
Right. But does hedging the cost of aluminum really offset the systemic risk of having, billions invested in infrastructure concentrated in one country, relying on one main bottle supplier? It raises questions about which risks they prioritize.
That's a fair point. And speaking of concentration, it's not just suppliers, is it? Their customer base is concentrated too.
Very much so. Their top 10 customers accounted for 58% of their total net sales in fiscal 2024.
More than half their sales from just 10 customers.
And it gets even more concentrated. One single wholesaler, just one, handles their beer portfolio distribution, accounting for a quarter of their entire company's consolidated net sales.
Wow. 25% tied to one distribution partner. That's a massive single point of potential failure if something goes wrong there.
Huge reliance. And maybe related to managing these big operational footprints, it's interesting that Constellation's filings also call out specific environmental goals.
Like ESG stuff.
Yeah, but tied directly to operations. Things like restoring 5 billion gallons of water withdrawals between fiscal 23 and 25, and getting zero waste to landfill certification for key facilities, given how much water brewing uses and the scale of their manufacturing.
Those aren't just PR points. They're probably operational necessities to manage resources and risk long term.
Exactly. Central requirements.
Okay, so we've seen market risk with Boston Beer and this massive capital and concentration risk with Constellation. Now let's get into that third big variable control. Who actually runs the show?
Right, because both Boston Beer and Molson Coors show how these foundational power structures can kind of overshadow the fact that they're publicly traded companies.
How does that work? Let's start with Boston Beer again.
Well, Boston Beer is probably the clearest example of absolute founder control you can find. The founder and chairman, C. James Koch.
Jim Koch, yeah.
He personally holds 100% of the Class B common stock. And that Class B stock, it has all the voting rights. It lets him elect a majority of the board of directors, period.
So the stock that trades on the New York Stock Exchange, ticker SAM, that's Class A.
That's the Class A stock. And those shares have basically no voting rights except on very specific rare things like certain types of mergers or changing the charter.
So essentially, Mr. Koch has substantial, arguably total control over any major decision that requires shareholder approval, regardless of how many Class A shares are out there.
That's the power of the dual class structure in this case. It locks in founder control.
Okay, so that's one model. How does Molson Coors compare? They also have a dual class structure, right? But it's different.
Yeah, it's different. At Molson Coors Beverage Company, the dual class structure isn't about a single founder. It involves two historic families, the Molsons and the Coors families, sort of working together.
Ah, the original brewing families.
Exactly. And you see active family members from multiple generations still deeply involved. On the Molson side, Andrew and Jeffrey Molson. On the Coors side, Peter H. Coors, David S. Coors, Peter J. Coors. They're serving as directors. Some are employees.
So how is the control structured then?
Their governance is explicitly set up to maintain this balance between the two families. They actually have separate nominating subcommittees for the board, one for Class AC directors, Coors, and one for Class AM directors, Molson.
So the families effectively control the board nominations and therefore the strategic direction. It's about protecting that generational influence from both sides.
Precisely. It ensures both founding families maintain significant, entrenched influence.
Okay, so with that kind of concentrated control, either by a founder or by families, how does that shape maybe more modern corporate concerns, like executive pay or managing risks like cybersecurity?
That's a great question. It definitely influences things. Let's take executive compensation at Molson Coors. Their filings talk a lot about their at-risk pay philosophy.
At risk, meaning tied to performance.
Exactly. A significant chunk of pay isn't guaranteed. For CEO, they state about 88% of their total direct compensation TDC is considered at risk. For the other top executives, the NEOs, it's around 76%.
88% for the CEO. That's a lot riding on performance. What kind of performance?
It's tied to several metrics, things like relative total shareholder return, how their stock does compared to similar companies in the S&P 500 Consumer Staples Index. Also, underlying income before taxes.
So financial metrics.
Financial metrics, yes. But interestingly, also what they call a people and planet scorecard.
Yeah.
So they're explicitly tying a portion of that at-risk pay to hitting ESG targets, not just financial ones.
Linking pay to ESG, that's becoming more common, but interesting to see it quantified like that. Okay, what about cyber risk? That's huge for any big company now. How do, say, Constellation and Molson Coors handle oversight?
It's actually a subtle but potentially important difference in their structures based on the filings. At Constellation Brands, CBI, the main oversight for cybersecurity seems to rest with the audit committee of the board.
The audit committee.
Okay.
Yeah, their chief data and information officer and their chief information security officer meet with the audit committee quarterly. They discuss threats, programs, how things are being managed. It treats cyber primarily as like a financial diligence and compliance risk.
Okay. And Molson Coors.
Molson Coors takes a slightly different approach, it seems. They explicitly list technology, including things like e-commerce, new media, cyber threats, as a key expertise area they want on their board of directors.
So they want directors who understand tech deeply.
Right, and more than that, they have a dedicated technology subcommittee of the board. Its specific job is to oversee and review their information security and cybersecurity programs, policies, and the threat landscape.
So it's not just part of the audit committee's job. It's got its own dedicated subcommittee at the board level.
Exactly. Which suggests, perhaps, that Molson Coors views cyber not just as a financial risk to be audited, but as a core strategic operational risk that needs specialized, ongoing, board-level focus. That is an interesting distinction. One routes it through finance audit, the other gives it a dedicated tech focus at the board level.
Yeah. Subtle, but could reflect different priorities or perceptions of the risk.
Okay, so let's try and pull this all together. We've looked at quite a bit here.
We have, and we've seen some really distinct strategic paths, haven't we? You've got Boston Beer grappling with market volatility, pushing hard on product innovation, but carrying this significant contractual risk from that seltzer slowdown.
Right. Then Constellation Brands making these enormous multi-billion-dollar bets on infrastructure and scale in Mexico, trying to lock down their supply chain and hedging costs like crazy.
And underpinning both Boston Beer and Molson Coors, these powerful governance structures. Dual-class shares, ensuring that founder control or family control remains absolutely central, kind of insulated from the day-to-day whims of the public market.
Yeah, it's clear that success, or at least survival in this high-end beverage market, isn't just about having the next hit brand. It seems just as much defined by who holds the ultimate control and their willingness to deploy massive amounts of capital.
Absolutely. Which leads to, I think, a really interesting final thought for you, the listener, to chew on.
Okay.
Given what we've seen, the huge capital needed for production, like Constellation's $3 billion bet, and the extreme volatility we saw with Boston Beer and hard seltzer, how much does innovation or being nimble truly matter in the long run? If the ultimate voting control stays locked in the hands of just a few founders or families.
Does that concentrated control ultimately help or hinder their ability to adapt over the very long term?
Exactly. What does that structure mean for the future agility, the future bets, and maybe the future consolidation of this whole high-end beer and beverage market? Something to think about.